Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Hello and welcome to this week's edition of Wealthy and Wise. I'm Nadine Blaney from AusBiz. Well, some of the world's best products have been terrible investments, and some businesses with fairly ordinary products have created enormous shareholder wealth. This week on Wealthy and Wise, we're exploring a crucial distinction that many investors miss, and that is the difference between a great product and a great business, and why understanding that difference can transform your investment results. We'll also take a look at some specific companies and, as always, answer a viewer question. First, though, let's add some value. Well, as consumers, we're naturally drawn to products we love and use every day, but investing isn't about buying products, it's about buying businesses. So in this segment, we unpack why a brilliant idea doesn't always become a successful company, and while popular products don't always generate strong returns, and what investors should really be looking for. So, welcome to the program, Howard Coleman from Teaminvest. To my right, we've got Sanjee Narendran from Teaminvest as well. Sanjee, this is sort of a topic that I know you love. So let's start with the basics. What is the difference between a great product and a great business?
Well, there's lots of really great products out there in the market. There's things that the demand is huge for, people get great use out of them. But it doesn't mean that those products ultimately run as a great business for the investor.
And we will be getting to examples a little later on. But Howard, why do you think investors so often confuse the two?
Well, I think what it really is that people look at something and they say, this is the best. Therefore, it must be the best one to own shares in. But that's a far cry from being the same thing. I mean, if I give you just a couple of historic examples, when being able to record TV shows and things first, or anything else became popular, there were three systems. Philips had a system, Sony had Betamax, and then there was VHS. Everybody said VHS was the worst. The quality of picture was worst, you couldn't do things as easily. Sony was better, Philips was the best. Philips's division closed down having made a loss, never ever made a profit for Philips. Sony struggled on for a number of years and eventually gave up, and VHS became the world standard, and the companies that put it together, Panasonic and others, became extremely valuable investments. So the best product wasn't necessarily the best business. Yet, and we saw it with Microsoft and Apple. They used to joke about Microsoft's operating system in the early days, that if cars ran the same way, every now and then your car would stop in the middle of the road, you'd have to switch it off, get out the car, close all the doors, lock the car, then unlock the car again, open all the doors, get in again, put your key in again to start it, because you had to keep booting up your Microsoft computer, 10 times a day. Yet it landed up being the very profitable business that it became. I mean, one of the great businesses of the modern era.
Yeah. I still have some Betamax tapes kicking around from my early days in TV. I'm aging myself.
Sure you do.
But it was superior, and that's why
Absolutely.
broadcast still used it for many, many years after VHS took over the home. So, Sanjee, what are the key ingredients that turn a product into a successful business?
Having a great product and having great demand is obviously a starting point. It is absolutely valuable in having the great product, but then being able to price it correctly, being able to meet the demands and also produce it efficiently. A lot of that comes down to management, how capable they are finding the best ways to produce it that actually returns a good investment for their investors.
And how to market it too.
Yeah, that's right. So there's a lot of components between having the product and where the investors actually get their returns, because the investors' returns are really at the profits. And there's plenty of spaces in a business where profits can disappear if you're taking on a lot of debt, or if you're paying big interest bills, or making acquisitions of other businesses that fail. And there's a lot of things that a business or a manager can do that could see the profits slip away, even though you started off with a fantastic product.
So it's the execution, right? And management just absolutely crucial.
Imagine if a company that you owned shares in sent you a letter saying, we're not paying a dividend this year, but our products are definitely the best. You should buy them.
But just taking that one step further, sometimes companies do not pay a dividend because they're reinvesting in themselves to create the next product or a better product or make improvements to the product. How do you feel about that, Howard?
Well, if they had really high return on equity, they'd be able to do both. Because if you've got really high return on equity generating good margins, you should be able to pay a dividend as well as having sufficient to reinvest. So when a company says they need to use the money to reinvest, what it says is their profit margins are really quite slim. Because if their profit margins weren't so slim, they could do both.
So, Sanjee, what warning signs do you look for, or what are some red flags that something might be a great product but a weak business model?
Well, maybe we look around the other way, and what we would try to look for that shows that it's a good business is a business that has some moats around it. And when they've got solid moats around the business, they stop competitors from coming and eating market share. They're able to go and get that high return on equity because they have pricing power. And that speaks to not only the product, but the demand and the business. So if you're looking for businesses, I'd suggest looking for what type of moats are around these businesses that protect it and can hold through a long run, a long period of time, to prevent it from competitors coming in, taking market share and eroding your capital, or giving management the capacity to expand and grow and do more marketing or product innovations because they're earning enough out of the initial business, not trying to supplement it with further additions without actually getting enough margins or being able to realize the value of that product.
So it's, again, getting to the basics, getting to that checklist that you like as a value investor. On the flip side, though, Howard, can a boring product ever become a fantastic investment?
Oh, absolutely. I mean, there are lots of boring products that become wonderful investments that people don't even think about when they buy it. I mean, if you think about it, one of the huge type of industries around the world is oil and gas. Now, do we get excited about going and filling up our cars with petrol? No. We go along, we think it smells a bit. I won't stand too close to the pump. We fill up the car with petrol, we go inside to pay for it, and what a hassle. It wasted 5 or 10 minutes. I could have rather been doing something else. So that's a very boring product. But petrol companies and oil producers have in some cases been wonderfully good businesses. There are more of them that have failed, but the ones that have been really well run have been really good businesses for their investors.
Okay, well, I think we've got the basics settled. I'd like to get on to our head-to-head segment. We'll put some of these companies under the microscope, ASX listed companies as well. Stay with us. Okay, so the theory is one thing. The real test is what happens in the market. So let's look at companies across 4 categories. Ideas that aren't yet businesses, great products with weak economics, ordinary products with strong economics, and businesses selling essentially the same thing but producing very different outcomes for shareholders. Did you get all that? All right, let's break it down further with my guests, Howard Coleman from Teaminvest and Sanjee Narendran from Teaminvest as well. All right, so let's start, I guess, by examining what prevents a great idea from becoming a great business. Or do you have a couple examples of that?
Yeah, I think there's a lot of, there's a couple of businesses or listed entities at the moment. I hesitate to call them businesses, but they're listed entities that get a lot of popularity. They're quite well known, but I wouldn't call them an investable business. They've got potential, their products. It's at this stage, to me, it's still a concept or an idea. A good one is NexGen. It's been quite popular in the market. I'll bring it up on Conscious Investor, and we'll see how that looks.
So this is actually a Canadian company as well, isn't it?
It is a Canadian company. They're a miner. I know, everybody knows how we feel about miners in general, but this is a particularly uranium miner, trying to produce low cost, low development uranium. But looking through this data, you can see this is a business that doesn't make profits at all. And if I take you down to have a look at the earnings here, there's actually no revenue. So it's not only making profit, not making profits, there's not even earning any money as revenue. So it's still an idea, it's still a concept, there's still a potential, but is it a business that you could actually make an investment in? It'd be way too hard to value when they're losing anywhere between 100 and 200 million a year. Or, you know, they did have 1 year of profits there, but it's significant losses there. And what do they have to do? They keep mining their shareholders' wallets. They keep having to raise equity, raise prices, but the market receives it as very popular and very topical. But to me, it's not yet a business. Another one that may be worth looking into is Mesoblast.
Oh yeah, so we've been talking about Mesoblast for a very long time. Skin cell treatments,
Yes.
you know, all of the hope that brings. Did it bring a good business?
Well, I mean, they've got a full 10 years worth of listed history here.
And in fact, they go back further. Nadine may remember to when, but I remember it even before that 10 years.
Yeah, for sure.
And if you look at, you know, over the last, if you focus on the earnings and the sales here, over the last 9 years out of the last 10, they've on average lost about $100 million a year. And what type of revenues they're making is next to nothing. So again, this is not something I'd consider a business or an investment. This is a speculation of they have something, potentially they might do something, but how do you go out and try and find a appropriate valuation for a business like this? You're just, I mean, your returns and your odds are actually better going to the casino.
So that's an example of what could potentially be a great idea, but is just not a great business.
Yeah, I hope Mesoblast succeeds.
That's right.
Okay, so let's consider now maybe a couple of companies that most people would recognize, potentially even admire the products, but that you reckon still don't make very good investments.
Yeah, well, anyone running a business has probably come across Xero in their accounting software. It is a fantastic software. I know our accounts team uses it, and it's rightly so that it's a great product. But let's have a look at it in terms of an investment. So as a business, if we're going to look at their return on equity, it is, when they have made profits, it's been very, very slim. Again, going down to what are their sales doing? Their sales are growing, but they're not that profit is not translating back to the shareholders. Now, it's one thing that people should remember: as shareholders, we are the owners of these businesses. So you should treat them and assess them as if you are the owner, not just trying to speculate on stocks as to if I buy it, will somebody else buy it at a higher price from me? But is this the type of business that you would want to be or reliably be invested in, to think that it will be materially higher in 5-10 years time? But when its earnings and profits are just up and down like that, and when it does make profits, it's not particularly great. I can't really see that as a great business to be invested in. But as a product, fantastic product. I'll be a user.
So that's that lack of stability that we've spoken about in previous episodes. So what's another one that's a product that we like that you just don't think makes a very good business?
Well, I've been seeing, well, let's look at the US.
Okay.
So if we look at Tesla's hugely popular, and I know, you know, with SpaceX coming out and all sorts, it's very topical, but...
And everyone who drives one raves about it.
Absolutely. So, I mean, in terms of a car and being the first electric car to market, it was a great achievement for them to get out that electric car to the mass market, and that became very, very popular very quickly. But in terms of, is it a business? I mean, the amount of losses that it had to sustain to only now start making some profits, and the volatility in all of that, and the constant capital raisings that need to go with that, it makes it a very difficult business to be invested in as a long-term investor. There's so much going on in this business in Tesla, and then you also have to look at management as well, and people will have to form an opinion of Elon, but it's a very, very complicated business to understand. It's not something that I would find comfortable to be an investor in for a long period of time, because anything can happen here.
And they've never paid a dividend.
No.
Yeah, so Howard, in your view, if you take Tesla or even SpaceX, it's investors paying too much for growth and excitement. You know, they're buying the story.
Yeah, absolutely. And, you know, it's very important to have stock markets where people can buy a story, because if not, great ideas would never be able to get any funding. The trouble is prospectuses are marketing documents. That's what they're for. You want to persuade people to buy shares from you. And why would you want to sell some shares? Well, because you'd like to sell some shares and get the money, either to use in the business or to use yourself. So people have this belief that if something is going to sell to other people for lots of money, it must be worth a lot. Well, only if the people still want to buy it for lots of money at the time you want to sell it. And that isn't necessarily the case. And, you know, if you go through all the big crashes on stock markets in history, they've always occurred, or almost always occurred, just after very large IPOs.
Well, we're falling into last week's territory, so I'm going to go back to you, Sanjee, and I like seeing the numbers on the screen. Sorry,
just before we move on from Tesla, the other thing to consider is that PE ratio. How much is Tesla being valued at for what it's actually worth as a business? The PE ratio on Tesla is 333 times.
Oh, that's, yeah.
So, you know, even looking at its earnings there at $4.1 billion US, 333 times it's got to increase its earnings. Now, Tesla from this point on, can it increase so significantly that it can justify that valuation if a market average is under 20?
Unreal. All right, so maybe you can take us to a couple of companies that perhaps don't inspire a lot of excitement, you know, but are very strong businesses. So again, that product versus business sort of scenario.
So if we're looking at a relatively boring business, but still one of my favorites because I like boring businesses, but Data3, I think it's an absolutely fantastic business. They don't have to produce anything. They are resellers of hardware, and they resell Microsoft and various other software services. And they provide the maintenance and the support for governments and large corporations to use it. It's nothing groundbreaking. It's nothing fantastic. It's something that
got lots of competitors.
Lots of competitors. It doesn't get a lot of coverage. People don't fall head over heels with it and see it in the news every other day. But it is a business that just goes consistently very strong. And if you're looking at its earnings there, I mean, going from about 30% return on equity to about just under 60% return on equity, it's got to be one of the best. And in terms of its growth, over 10 years, growing at an average of 16% is a very strong growth that the market completely underestimates, and it does it very stably.
And it pays out almost all its earnings every year in dividends.
That's right.
It doesn't have to reinvest any of it.
It's about a 90% payout ratio for that. And if you're looking at going back and looking at your earnings and profits, absolutely, you know, it's gone from 13 mil in earnings down to 48 mil, up to 48 mil, sorry, I should say. But it is a business that just keeps steady, keeps growing, but it's nothing very sexy to the market. It's nothing that you write too much about. It carries on, it does its business.
Yeah, well, partly because I have asked them for an interview before and they have not returned my phone calls. So Data3, you're on my list. Okay, what's another sort of average product or boring product that is making a good go of it in terms of business
and
fundamentals.
In fact, it's an interesting thing. If you ask yourself why have they probably not bothered coming on the
they
show,
don't care.
They don't have to sell a story. The business is a great business.
Yeah.
That's it. They don't require capital raisings.
So
there's no story to sell. It's just business as usual. But what's more boring than insurance? So
not a lot.
if we have a look at NIB, so NIB Holdings, health insurer, I mean, their return on equity it's great. It's a great business. It just keeps making money, keeps showing the returns there. Growth rate of about 6%, very stable. Doesn't need a lot of debt. It doesn't have to raise a lot of capital. It's raised a little bit, but doesn't have to raise a lot of capital. But it just keeps making profits from about 95 million 10 years ago to over 200 million now.
And if you go back a little further, when they first listed, if I remember correctly, there was something like 60 health insurers in Australia, and they were about the 50th biggest. They were that small. Now they're the third biggest in Australia. So everybody else is doing the same thing. Everybody in that industry is providing health insurance. Most of them have collapsed, don't exist anymore. There's now only, I don't know, maybe 15 of them, I think. I may be out by a bit. Instead of the 60 odd that there were. And NIB has grown its percentage of the market faster than everybody else. What are they offering that's better than anybody else? Why is their product better than anybody else? I don't know, can't tell. All these health fund things are so opaque you can never work out which one's better.
Yeah, interesting. All right, so there you go. Now, there's another way that we could look at this as well. So what about companies that are sort of, I don't know, they've got similar type products or in a similar sector, but one is a good business, one is not?
Yeah, I got a great example for that. Let's have a look at supply networks and MaxiParts. And actually, Howard has quite a bit of knowledge on the industry a little bit. So I'll bring up supply networks and we have a look at from an overall.
I was once on a board for a couple of years of a direct competitor of these two companies.
Yeah. And so supply network, what are we looking at
So
here?
we're looking at here the return on equity. Again,
Growing.
it's very, very strong return on equity. The growth is about 26% year on year for the last 10 years. And very stable growth there as well. Their debt is only around 35% debt to equity. They have a 75% payout ratio, so they are paying their dividends. They've been growing their net profit margins. And
if you look at the earnings there, the profits, it's gone from just under 5 million to 40 million over 10 years.
Yeah, so this is truck and bus parts, essentially.
That's
I'm
it,
simplifying it. So MaxiParts
Pretty
also,
boring.
yeah, okay, is also small cap in the
Same industry.
Same industry.
yeah. Very similar.
So let's take a look at the metrics on that.
So having a look there, the return on equity, it's always been in the single digits, where you've seen supply network never hit the single digits, they were always double digits. So return on equity, return on capital is always pretty low over there. Their growth has gone backwards, almost negative 12% year on year for the last 10 years. They're holding about 60% debt to equity. Their payout ratio jumps up and down, but it's sitting down around 40% or 44% last year.
A few years where they didn't pay a dividend
Yeah, a
at all.
few years they didn't pay. But from 9.4 million, now where are they 10 years later at 7.7 million?
Mm-hmm.
So if you have a good business and your business grows, so does the valuation for that business. So finding good businesses, regardless of the products that they sell, I mean, it is one factor to consider. But putting that aside, if it's a good business and it's continuing to grow, that's an investment that can keep growing and grow your wealth and your portfolio materially.
Yeah, and so what you're saying, guys, is, you're not even that interested in why management at MaxiParts hasn't managed to pull off what Supply Networks has, you're looking at the figures and you can see the stability, you can see the value, you can see the growth, and that's all you need.
Yeah. So you'd look at something like Supply Networks and say whenever the price is reasonable and the PE is reasonable, it would be great to buy a piece of that business because it's a great business. On the other hand, you'd look at MaxiParts and say, whatever the price, it's a lousy business. Why would I want to be involved in that business?
All right, so that's it. Product versus business, and you can see it through the conscious investor lens. I think it's time to get to our viewer question because you asked. All right, let's get to our viewer question of the week. You too can get a question answered, wealthy@ausbiz.com.au. And I think this one comes from our topic last week. We were talking about some of those big blockbuster IPOs. And the question coming in from our viewer, do Teaminvest members ever participate in IPOs? All right, let's get a view from you, Howard.
Well, we don't know for sure whether they do or don't, but certainly nobody would tell us that they would participate in IPOs because our members regard an IPO as a marketing document. That's what it's for. It's designed to persuade people that they ought to take some of their money and put it into this company. And the person who is the founder of the company or the company that's looking to raise the capital wants to paint that to look as good as it could. I think it was Warren Buffett or Charlie Munger who said they put lipstick on a pig. And that's the idea of an IPO. So Teaminvest members who are looking for companies that they expect to do very well out of the next 5 years, not the next 5 minutes or 5 months, I would think steer completely clear of IPOs.
Yeah, same, Sanjee?
Absolutely. I mean, there's always a lot of hype around IPOs. There's a lot of money when brokers do IPOs. There's a lot of PR that goes on. So the exuberance that comes around some of these really big IPOs is, it's very, very high. So quite easily you'll find yourself overpaying for what it may be an ordinary or lousy business just because you get caught up in the hype.
Yeah, all right. Gentlemen, thank you so much. Howard Coleman, Teaminvest, Sanjee Narendran, Teaminvest as well. Thank you for joining us, and thank you for watching. That's the show for this week. We'll see you in the next.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.